before we get started, let's check out the links in my description. We all want nice things. We want the car, we want a house, we want a high limit credit card. But if you don't have at least a 680 credit score, you're not even in the game. So click this link here to know where you stand and get your free credit scores from all three bureaus. That will be Experian, TransUnion, and Equifax. And also get your reports. If you would like to be free and become financially independent through entrepreneurship, click this link here to be free. If you'd like to get cash back, which is a discount during shopping, please click this link here to see my favorite cashback sites. And if you enjoy the music you hear in the background, please click the link here and subscribe to It's Oasis. Hello everyone, welcome back to Community Wealth. Today we're going to go into a little bit more about what goes into your credit score, but we're going to focus on utilization. We're going to go into what utilization really is and how to calculate it. But first, if you would like to know what's in your credit report and your FICO scores for all three credit bureaus, Equifax, TransUnion, and Experian, click the credit monitoring link in the description below. And that way you can get all three scores for all three bureaus plus your reports. If you'd like to make $500 to $1,000 plus per week utilizing your personal vehicle on your own time, click the Wealth Dasher link in the description below. And if you don't have a vehicle or you don't want to use your vehicle, you can click the Wealth Hire Car link in the description below. And that way you can use in conjunction with the Wealth Dasher link. And that way you can make $500 to $1,000 plus per week using the hire car. If you would like to know how I got 5 properties for $5,500, click the Be Free link in the description below. If you would like to earn cash back on your online shopping, especially this holiday season, click the Cashback link in the description below. Now, let's go ahead and get started. The best way to raise your credit score is 2 different ways. Well, not 2 different ways, but you can use these 2 ways and it'll boost your credit score the highest you can go, because these are the highest places, all right, the highest things you can do, or the things you can do that are worth the highest in building your credit score, right? The first thing you can do is, of course, pay your credit cards on time, or pay all your bills on time, because payment history is 35%, okay? The second thing you can do is keep your revolving credit utilization down, preferably under 10%. Let me show you the breakdown, okay? Here are your credit score ingredients. You have payment history, which is 35%, amount of debt, which is 30%, the length of credit history, amount of new credit, and credit mix. Payment history is 35%, and payment history is overall credit. That's including your credit cards, any loans you have out, whether it's student loans, auto loans, mortgage loans, personal loans, line of credit, anything you have out. This is that goes into your credit history. Your payment history, that goes into your payment history. And that counts for 35% of your credit score. Okay. See, my payment history is good. All right. It says right here I have 4 late payments, but that was almost 2 years ago. We're talking about at least 19 months ago, my last late payment. Okay. And that was, like I said, that was over 19, almost 2 years ago. Okay. I say my last late payment was maybe February of last year. I believe that's what my last late payment was, February of last year. All right. You have your payment history that counts for 35%. So it says how you've paid your bills in the past, whether you've paid on time or late or missed payments, is a very important category of credit data for the FICO score. The more severe, recent, and frequent the late payment information, the greater the impact on a FICO score. So the older it is, the less impact it have. And after 24 months, you could pretty much say it has really no impact at all. It's very little. It still has an impact, but it's virtually almost no impact at all after 24 months, after 2 years, okay? The amount of debt. So here it says the amount of debt is 30%. The amount of credit you're using is a very important category of credit data for the FICO score. FICO score is considered the total balance owed, how many accounts have balances, and how many of your available credit you're using. How much of your available credit you're using, okay? Now again, it's 30%. So once you accumulated your debt, the best thing you can do is have your revolving credit at 5%, because that's mainly what this is about. It only really calculates your revolving credit, and your revolving credit is your credit cards and your line of credit. If you don't have a line of credit, then it's your credit cards. And some of the loans will be listed as a line of credit as well. And so that will kind of mess you up. I've heard some furniture loans, when you get the loans for furniture, they count that as a line of credit. I don't know which ones do, but if they do, I probably wouldn't get a furniture loan. If you have enough credit, just put it on the credit card, all right? You see here it says I'm using 3% of my revolving utilization. And this is percentage of your revolving balances to your revolving credit limits. Okay, I have 4 accounts with balances. Number of your accounts with a balance, $104. Total balance on revolving and open-ended accounts. Total owed on revolving and open-ended accounts, okay? So you say it shows 5%, but the 5% is the total. Remember, I have one of the credit cards on my credit report that's a authorized user. So what this 3% is representing my personal credit cards, okay? So not the credit card that I'm authorized to use on this. These are my own personal credit cards that this is calculating. It's the ones that I use for myself, that I got under my name, that I'm a authorized user on. And so it shows you that my utilization is very good. And your length of credit, you know, that's how long you had your credit. And it calculates that from the longest to the shortest. So it says FICO score is taking into account how long your credit accounts have been established, including the age of your oldest account, the age of your newest account, and the average age of all of your accounts. My credit history is good. My longest is 22 years and 7 months. And the average age of my accounts is 4 years and 11 months. Okay. So that's my length of history, and my length of history is good. That's your newest credit. My new credit is good. I have actually 2 very new accounts, and that's my auto loan and my resort membership loan, which is considered a real estate loan. So when considering your amount of new credit, FICO score is taken into account how many new accounts you've recently opened and whether you've been rate shopping for a single loan or applying for multiple new credit lines. Opening several new credit accounts in a short period of time indicates greater credit risk. So I only have 2 new accounts. You can say 3 if you want to count the authorized user, but it's not my actual account. Again, I'm an authorized user on there. Now it's counted as new credit since December of last year. But if you want to count my actual new credit, that will be the auto loan, which was in May, and in July, that was that real estate loan. And have a good credit mix. That's 10%. 3 months age of most recently opened account, and that would be the real estate loan. Number of recent inquiries, which is 2, your applications for credit in the past year. Now here it shows the credit mix. FICO score considers different types of credit accounts being used or reported, including credit cards, retail accounts, installment loans, and mortgage loans. Your credit mix will be more important if your credit report doesn't have a lot of other information to base a FICO score on. So my credit mix is very good. Revolving, yes. Revolving accounts being used or reported, yes. Installment loans including mortgages, being used as reported. Yes, bank issue credit cards being used or reported. But we're going to focus on utilization, all right? The reason why utilization is important because it's 30% of your actual FICO score, okay? So, my utilization is at 3%. On my Cash Rewards credit card, the balance on it is $92. And $92 is like 2.9%. of my credit card limit. And my First Premier card, remember I told you to get a First Premier card if your credit is bad or you're trying to build credit, get a First Premier card. They're very easy to get. All right. That's a $700 card, and I have that at $12, and that's at like 2.8 or something like that, 2.8%. And so now that's averaging out at 3% for my credit cards. All right. That's my personal credit cards. And then you have the 5% for the Amex card that I'm authorized to use on. So that's sitting on 5%. So that really got me averaging around like 5%. All right. Because that Amex card is at around like 5 or 6%. And my other cards at 2.9%. So that's got me at averaging around like 5% utilization. Okay. But since that's 30%, you get your utilization under 10%. And that's what they're going to be reporting to the credit bureaus every month. They're going to be reporting under 10% every month. And with that being 30% of your credit score, that's a huge jump in your credit. Let's just say you have a few negatives on your credit report and you have a credit card or two that's reporting at 10% every month with on-time payments. So you have on-time payments and you have a 7% utilization every month. Well, let's just say you're on-time payments all the time, but you have one or two cards that have high utilization. Once you get those cards down you can play the tier game. You can say, okay, I'm gonna get it down under 30%, then I'm gonna get it down under 20%, then I'm gonna get it down under 10%. You get all of those points every month. I've done that. You get all those points every month. Every time you get it down to another level, it jumps up. Well, let's just say you at 25% this month, and next month it reports under 10% because you got your credit card down to under 10%. Like if you had a $1,000 credit card and you had $250 on it this month, that's 25%. But then next month you have it down to $50. That's 5%. Right? So now you got that credit card down to 5%. Your credit score is going to shoot up. You're talking about an easy 25, 30 points just because of the utilization factor. Remember, that's 30% of your credit score. So you want to have not only do you want to have your payments on time, you want to have your utilization low. That can negate a lot of stuff. Remember, I've done it. I had late payments. I told you I had late payments. And then all of a sudden, my utilization is staying under 10%. But I played the tier game. I had to get it down to under 10%. But then once I got it under 10%, it stayed under 10%. And I got all the points. So that's a great way to jump your credit score up, is to get your utilization down. If you have 3 cards, just, get one down under 10%. And that'll be the lowest credit card. So if you got like a $500 credit card, you get that down under 10% first. Okay. So you get it down to 7%. So you got a $500 credit card. You want to get that credit card down to, let's just say, $30. All right. So now you're under 10%. $30. All right. I say 25. But I'll say 25 put you maybe like 7%. So put you, 25 to $30. Now you got the $500 credit card down to, 25 to $30, and you keep it there every month. Never use that card, put it back down to $25 to $30. Now you're under 10%. Then you go to the next card. Your next card is $1,000. Now you get that one down to under 10%. So that's under $100. So maybe $70. So now you had that card at $70. Now you got your card at 25. That's $500. You got your $1,000 card at $70. So that's 7%. And then you have that $2,500 credit card, right? Now you got a $2,500 credit card. You want to keep that credit card down to around, let's just say $150. All right. So now you're under 10%. You want to keep that card at $150 every month. So now every month, all of your cards are under 10%, roughly around 7%. And that's where you want to be. And your credit score will shoot up just because of that alone. All right. So that's pretty much it about utilization. It's not nothing major to utilization. You just want to keep all of your credit cards and your revolving credit limits. Your revolving credit account, that could be a line of credit, your credit cards. Even if it's that furniture loan, it's kind of different because they're using a revolving account as an installment account, and that's not cool. So if you can, stay away from furniture loans. But if you have credit cards and lines of credit, you want to keep all of those under 10%, preferably around 7%. All right. So again, if you want to know what your credit scores are, all your FICO scores, and you want on your reports, click the credit monitor link in the description below. That way you can get all your reports and all your scores from Equifax, TransUnion, and Experian. Like to make $500 to $1,000 plus per week on your own time utilizing your vehicle, click the Wealth Dasher link in the description below. If you don't have a car or you don't want to use your own car, click the Wealth Hire Car, and that way you can use the hire car to wealth dash around town and make $500 to $1,000 plus per week. So once you get that hire car, you have to go and do the wealth dash so you can start dashing, okay? If you want to know how I got 5 properties for $5,500, click the Be Free link in the description below. And it's that time of year where you're going to get your holiday shopping on. So you want to get cash back while you're doing that. Click the Cashback link in the description below. And if you like the video, like and share it. Comment below. If you have any comments, any suggestions. And if you like the music, subscribe to It's Oasis. So subscribe to the channel, and until next time, everybody, let's get this money.